Would you like to know how to make money in the short time? Hey traders, and welcome back to the Quant Quest Academy, the place where the knowledge meets execution in the world of the finance market. I'm your host, Frank Sajurian, and today's episode is a game changer. We are diving headfirst into one of the most dynamic and high-stake forms of trading, day trading short-term options. This strategy offers the potential for the lightning-fast profits, but also sharp losses. If you don't know what you're doing, so if you ever wonder how traders make money by entering and exiting trading within minutes, using the options expiring in the few hours, this one's for you. Okay, let's kick things off with some definitions. Short-term options refers to contract with expiration dates ranging from 1 week to 0 day. Often refers to as a weeklies or zero-date options. These are the contract traders use to make quick directional plays, sometimes holding positions for as little as 5 minutes to the few hours, but almost never overnights. Why? Because time decay, theta, works aggressively against the options holders as expirations approaches. But if you understand how to surf this wave, it becomes your advantage. Day trading short-term options isn't just about the speed. It's about understanding how premiums move, how momentum builds, and how to be one step ahead of both price and volatility. So you might ask, why trade short-term options instead of stocks? Why not just trade the stocks? Great questions. Here is why many traders prefer options for intraday moves. First, leverage. With a fraction of the capital, you can control 100 shares of the stock. A small move in the underlying can result in the large percentage gain in the options. Second, defined risk. When buying an options, your risk is capped at the premium paid. Third, magnified returns. A $1 move in the SPY might not excite a stock trader, but the short-term options on the SPY that can double in a minute. Fourth, quick capital returns or turnovers. You are in and out. No margin calls, no overnight surprises, no stress over the post-market earnings. But with this power comes risk. You are dealing with a high-stakes instrument that's sensitive to the time, volatility, and the momentum. So you need precisions, and that's what this video is all about. Now let's talk Greeks, because when you're dealing trading options, not all of them matters equally. First, delta. Delta tells you how much the options will move for every $1 move in the stock. Short-term traders often prefer options with a delta between 0.40 to 0.60. This offers the good movement without being too expensive. Second, theta or time decay. For zero-date options, theta is like a ticking bomb. You want to be in and out fast. The longer you hold, the more the premium erodes, unless you are deep in the money. Third, Vega. This measures sensitivity to the implied volatility. On the calm day, Vega isn't your friend. But around the events, like Fed announcement, rising IV can boost your options value. It's a double-edged sword. Fourth, Gamma. These ones big for the short-term traders. Gamma tells you how fast the delta is changing. High gamma means small stock moves can quickly push your options deep in or out of the money. Ideal for the quick scalps. Now let's switch gears for a minute and talk about something even more important than strategy, your mindset.
Bingo!
Day trading short-term options isn't for the faint of heart. It demands patience to wait for the right setups, disciplines to cut losses quickly, clarity under the pressure, and above all, emotional control. You will have losing trades. Everyone does. The goal is not to win every time. It's to manage risk so that your winners outsize your losers. Professional traders doesn't focus on being right. They focus on being profitable over time. So write this down. Small losers are tuition. Big losers are ego. If you are revenge trading, increasing size after a lose, or escaping a stop loss, you are sabotaging your edges. This game rewards the patience and punishes impulsivity. Now let's get technical. What kind of the setup works well for short-term options trading? Let's go through some proven ones. First, opening range breakout. Make the high and low of the first 15 minutes of the trading day. A breakout or breakdown of this range, especially with the volume, can lead to the explosive moves. Second, VWAP Bounce or break. VWAP is where the institutions like to do businesses. Watch for bounce of VWAP during trend. Continuation of the sharp breakout as reversal signal. Third, trend lines retested. Draw triangular support or resistance lines. A retest followed by the confirmation candle is often a high probability entry points. Fourth, gap fill reversal. If the stock gaps up but fails to hold early strength, it might fade and fill the gap. Great for the puts on the short-term weekends. Fifth, pre-market's high and low zoom. This acts like magnets or walls. Breaks with the volume often leads to the big moves. Choose one or two setups and master them. Don't chase everything. You are not here to trade noise. You are here to trade edge. Now let's talk about the contract selection for maximum efficiencies. Here is where many traders go wrong. They pick the wrong contract. Here is what you want. Expiration, weekly or 0 date, only if you are scalping. Avoid monthly expiration for daily trade. A strike has to be at the money or slightly in or out of the money. This strike moves fast, but decays even faster. Volume and open interest has to be high. This ensures tight spreads and faster fields. Bid and ask spreads has to be narrow. A wide spread eats your profit before you even start. And bonus tips, always calculate break events. A $2 premium on 100 calls means you need the stock to hit $102 just to be green. If you are trading SPY, QQQ, Tesla, or AMD, these names tends to have a liquid options with minutes by minutes. Follow. Perfect for the short-term trading. Now let's talk about the risk management. How you survive long-term. Let me say this clearly. Risk management is not optional. It is your survival key in this business. Here you are golden rules. Never risk more than 1 to 2% of your total account per day. Second, use hard stop or monitor closely if you are using mental stops. Have a daily maximum lose and stick to it. Set a maximum number of the trades per day. Avoid overtrading. Accept that missing a move is better than forcing a bad trade. Short-term options don't give you time to be wrong. If you are wrong, be wrong fast and move on. And finally, journal your trades. Write what setup you used, what you felt emotionally, and what you learned. This is how you grow from trader to professional. Alright, let's wrap with some advanced pro tips for leveling up. Use the options chain like a sentiment meter. See where the volume is clustering. It tells you where the action is expected. Watch for IV change intraday. Rising IV can inflate your premium even if the stock stalls. Play the time of day. First 90 minutes and final 60 minutes often carry the most volume and directions. Use stop limits orders instead of market orders, especially on the volatile contracts. Know when not to trade. Avoid low volume days, midday chop, or days before big Fed events, unless you are experienced. And most importantly, keep it boring. Great traders aren't addicted to the action. They are addicted to the repeatable setups and risk control. Okay, let's bring it all together. Day trading short-term options is a high-octane style of trading that rewards disciplines, preparation, and confidence. It's not easy, but with the right strategy, mindset, and the focus, it can be one of the most rewarding methods in the trading world. Thanks for spending time with me today. If you got value from this deep dive, follow for more breakdowns and drop your thoughts or favorite setups in the comments. I respond as many as I could. Until next time, stay sharp, stay focused, and always trade smart. Thanks.